Good day, everybody. This is Saya Credit, and we're here to discuss our business and what we've done so far, and what we plan to do going forward in Nigeria and other sub-Saharan countries. Saya is basically credit to buy more. We have been in the FMCG space for almost a decade, and one of the key things we have realized is that distributors can only meet 30% of their retailers' credit needs. And this has been a recurring problem we've been trying to solve in different ways. As it stands now, Saya Credit has been able to find a way to deal with this problem, to handle this problem. We have an interview from a particular retailer in Erejuwa, Bokno, in the city of Lagos. One of the key call-outs phrases from our interview with her is us saying, "I survive on the daily limits. I need credits to buy more goods to care for my family." This tells us that these retailers, the profits they make per day is what they trade with. And if they don't have if they're not able to buy enough, the profits they will make will also be limited. So what we are doing now is providing credits for these retailers so that they are able to sell more and make more profit to care for their families. And this is what we currently do. Saya helps the distributors to provide more credits to retailers. We've gone through several models and tried out different ways of getting these credits to the retailers, and we have come to the sweet spot where we've realized that we should provide this credit to the retailers through the distributors. It is the working model that we currently have. Actually gives us optimal results. Now, this is an overview of how it works. The distributor can see every transaction on their smartphone. That's the distributor sales rep can see, has access to impute transaction on his or her mobile device, can put in the units of goods to the bottom credits, the total, and on submission, the retailer has to approve it by getting a passcode. The passcode is the approval for the money to move from the retailer's non-checking virtual account into the distributor's account. And one of the key highlights of how it works is that no collateral is needed, no credit history needed, no app required, because we have we can run this via USSD codes also. So for retailers that are not tech savvy or are not technologically included, even with phones that are not connected to the internet, they can give approvals for credit sales to Apple via USSD codes that work on all kinds of phones. Then no digital or financial literacy needed. We're looking at $100 to $10,000 to $1,000 loan per retailer. That's the range. And we're looking at rolling it between 1 to 4 weeks. We're looking at an average 2.5% rate for the retailers per week. That's what we currently do, 2.5% per week. We roll it around 4 times every month. So that is on the average, generally what Saya does, how Saya works. Right now, we are seeing Saya. Saya is a scalable, gender-inclusive, very low-cost revolving credit at point of sale. One of the key differences between Saya and loan facilities is that the action is taken, the money moves from account to account at the point of sale, at the exact point of need. So you don't have to take what you don't need or borrow what you don't need. That's one. The cost is also relatively low. 100% of the retailers who are engaged are willing and interested in working with SIA and getting our credit. And it's also gender inclusive. Yes, over 80% of SIA retailers are women, but we're very open to men also. But I think the numbers come from the fact that we have majority women as traders across most of sub-Saharan Africa. And then this is easily scalable. That's one of the key highlights. We don't need too much. We need credit history. We need some other criteria to rate these retailers, to also rate the distributors. Under 24 hours on board, they have access to revolving credits monthly going forward. So these are the highlights of how SIA works. Okay, when we were trying to get lending partners, before we got alignments with certain lending partners that we needed to make sure that we optimize our credit scoring criteria so that our risk is minimal. Currently, we have less than 0.01 default rates. We're looking at when we scale, we still estimate that worst case scenario, we have less than 0.1% default rates because of our credit scoring criteria. The number one criteria is that the retailer, we must have the retailer order history with the particular distributor for between 6 to 12 months. Then the retailer location, a minimum of 3 years in the same location. Retailer category, we also help us determine the credit scoring, the peer and cohort performance analysis, the number of years in business, and then the general KYC, and then the amount of money needed. These are all of the things we look at. I'll focus on the sales history, retailer sales history. Yes, a retailer has been doing $500 on the average monthly. You can see, okay, this is what the person has been doing. How much extra does this person need to actually sell to have a 25% uplift? This is part of what we've worked out in our credit scoring criteria. And based on our work so far, we've seen that on the average, retailers do between a 15% to 25% uplift on their normal sales when given adequate credits. We ran our pilot for over 6 months in Abeokuta, and the results are very interesting. We are seeing the numbers, we are seeing the truth, the reality of how this works, how credit retailers work. And this diagram here basically shows the flow of information to help us get our credit scoring. Okay, this is a better picture of the credit flow. The distributors provide us data. The data includes the sales history for between 6 months to 3 years of these retailers. We run a credit scoring, we pass it to our credit scoring algorithm that also takes in some other information like certain market and peer review and some other requirements like what we call our BVN that allows us to have access to all their bank accounts at once. In case of a default, we can, or when we need to, for collection sakes, we can directly take out of the retailer's accounts without having to meet them physically. It makes the process smooth and easy. So on payments days, the money just gets a debit from the account. So we also make sure they have this BVN number, which gives us access to that. And other criteria helps us run the credit scoring. Okay, so we get this data, we offer a line of credit to the retailers. The retailers are able to purchase stock on credit. They make payments, virtual payments. They make payments via their virtual account to the FMCG distributors. In all of this flow, one key thing that is there is that they are cashless payments. There are no need for physical driving for collection, which makes our operations really, really seamless. In one of our first iterations, we had to go collect the cash from the retailers, but we've gone past that spot now. Yes, in the near future, we are looking at a point where we can get all unbanked retailers on board. That's a future plan. But for now, we are targeting bank retailers that do not have necessary bank records, but have bank records to take loans, to take the typical loans, or the typical loans are too expensive for them, but they have the necessary sales record to show that we can actually provide credits for their inventory. We also see the line where approved retailers at the end of the tenure, which is typically 1 week, they make repayments back into the virtual account, and so the cycle keeps flowing on and on. Now, based on our numbers and our market research, this is the market opportunity. The total available market is about 3 billion. That is, total credit needed by 1.2 million retailers in Nigeria is 83 billion. Of this 83 billion, the serviceable available market to SIA is 25 billion. That means the credit needs of 360,000 retailers who have the right kind of records for distributors we are looking for. Yes, we can service everybody, but to minimize our risk, we've seen that we can only service 360,000 retailers because these are the ones that have the minimum criteria we need to ensure we don't go above our risk levels. Of this 25 billion, we plan to disburse credit to 180,000 retailers in 3 years using, at that point, we'll be disbursing a $2 billion, and that's the size of the markets we are currently targeting across 3 years. Okay, so this is the competitive landscape. We see SIA as SIA is one of the few ones that actually give credits line, and it's also one of the ones with lowest interest rates, lower than 10%. All other banks and financial institutions don't play in this space at all. Most of them are in the micro loans, and they have high interest rates. So this gives us an advantage. Part of our additional advantages is that we currently have 2 lending partners, and we are working on getting additional lending partners to help us drive this. Then our credit scoring algorithm has proven to give us really, really low rates of default. And then we have a very strong network with FMCG distributors and retailers across Nigeria and other sub-Saharan African countries. So the team, Abraham Ojes, who is right beside me here, is an experienced product manager with background in marketing and business intelligence. He has created and launched several products, and he's a social and commerce expert. Then myself, Aito Joseph Osemegbe. I'm a seasoned go-to-market professional. I've worked with top FMCG companies, including Unilever and Pictet Cousins. And I'm a tech and financial inclusion consultant for multiple banks and startups. And we have Wale Martins, our CTO, who unfortunately is not here with us today. He's an experienced software engineer with a very, very strong background with fintech startups. He's currently leading the engineering department at Bento, which is a payroll solution for companies. So this is SIA Credits. This is us. This is what we do. I would like to know if you have questions.
Thank you very much for listening to our presentation. We apologized that we did not state the agenda earlier. Joseph had started off, with a rundown through what we do as Saharan Credits and how we offer value to micro retailers in Sub-Saharan Africa. Going forward, we will start a small chat. Trying to talk, basically give you more details about what we do at Saharan Credits. So it will be like a fireside conversation between I and Joseph, where I would ask him some questions and about his experience, working with retailers, about what he thinks are the prospects for the market as it stands, and what solutions he thinks will solve this problem more efficiently, and how Saya is doing this today. Thank you very much again, and please stay tuned. Yeah. So Joseph, welcome. Thank you for doing justice to that presentation, for going through what Saya is. Working with you as one of the best things. You are very, very vast. Having worked with a lot of FMCGs throughout your career span, and you understand the pains of these micro retailers, right? Credit is one of the the biggest challenge for these micro retailers. Some of them are underbanked and will likely not be able to get this particular credits. So walk me through how has distributors been solving this problem before now?
Okay, so a typical distributor wants to sell more, and so they give some level of credit. Now they give credit to retailers that have certain level of history with them. Retailers have been selling to for say 2 years or say for a year, and they've built some sort of relationship with these retailers. That's one key point. They also try to focus on retailers that have been in the same location for a while. We also see that I would say one of the pain points for the retailers is that the distributors do not give them the adequate credits they need. So a retailer needs $100 credits, or a retailer needs to make $100 purchase, but he has only $30. So he buys goods worth $30 and then gets additional credit of $20. But the remaining $50, he has to let it go. The distributor's sales rep visits these retailers on the average once in a week. If say from Wednesday to Wednesday, before the next Wednesday, the stock has been exhausted on the shelf. So the retailers typically miss 2-3 days without having those products on the shelf, and they wait for the sales rep to come again and make this supply, and it is almost never enough. Yes, these retailers want more, but they don't have the capital, they don't have the money to buy.
So how does this my second question so what I've finally seen when we go out to ask questions to sit down with these retailers is even with distributors too, is that these retailers, because they are cash constrained and they don't have access to that kind of credit to buy, in large, bulk quantity. They instead buy small quantities. So, like what you said, that 3 days where the retailer does not have any goods to sell, and it's because the retailer actually bought in a very small quantity, so that they don't have enough inventory to last them. So, what's the impact of that to the distributor?
Okay, for the distributors, they have less sales. Because they can actually sell more, but they're not willing to take on more risk, or even when they're willing to take on more risk, they do not have the capacity to give that much credit because it would be their own funds. The distributors also have limited funds, so they have to give to their own limits. So the direct impact is one, less sales for the distributors because I'm able to give out the right kind of credit. The cost of stock holding on the distributors, and also for the amount of credit that's even given, managing it, tracking the collection, tracking, reminding these retailers, and actually ensuring that no fraud happens between the distributor, the sales rep, and the retailer, that the process is smooth. It's a whole department on its own. It is expensive, it is time-taking, and many distributors are happy to outsource that, to push it and say, you know what, I want to sell to these guys on credit. I don't want to think about it. My work is to sell. I'm not a financial institution. I'm not a bank. I should not be tracking debts and payments and manage this credit and the payments. I just want to see my money. I want to sell and distribute goods. That is where we have our strengths. That's our capability. Our strengths. I'm saying the distributor now. Their strength is in distribution.
That's a core.
That's a core strength. When they start devolving into cash collections, debt collection, defaults tracking, payment processing, they are slowly becoming some sort of financial institution. That is part of why Saga Credit is about taking that burden off them, that risk of them, that stress of them. We're handling it. Yes, these distributors need to pay the mother company. Sometimes they get rebates and special discounts on them. They pay on time. So we are coming in, they are going to be getting that money, that discounts, because we are paying them for whatever they are giving to their distributors. We are funding their credits. So they'll be getting this extra rebates from the distributor to be able to ensure they don't have overuse. They will ensure that they are able to buy the right amount and kind of stock from the distributor and from the parent company themselves. So this is the problem we're solving.
Thank you very much, Joseph. Once again, majorly in Sub-Saharan Africa, is this gap, for access to finance. Majorly, it's most likely, as we've seen, a gender issue, where you see that most of the female traders are marginalized, right? They don't have access to capital like their male counterparts. So when you go to the market, you most likely see more women in trade, but the men in the market most likely have access to capital, you understand, than these women. And coming up with Saharan Credits, we have thought of ways of closing that gap, making sure women have access to finance. The same way as men, making sure it's a very, very inclusive solution for both genders. What do you see as a fact that would be a fast track solution to this issue of this gender gap, right? Do you think, or ever thought of this as why don't we create like a special fund for those female traders alone, so they could catch up with the male counterparts, even though there are more women doing this type of trade than male counterparts?
Okay, there's a need. There is the problem of accessibility to credit for women. I have a particular retailer, her name is Iyabola Rewa. She was going to take credit at about 5% rate, and for her it was high, but she was willing to do that. She will still make her margins will cover that, and she got to this financial institution, and she had to bring her husband in as a further reference before she gets the loan. The husband, she's able to convince her husband after several months, and then he comes and he sees the amount of the loan, and he gets scared and he's thinking, okay, why don't you just live a simple life? So what happened was she didn't get the loan because the husband refused to sign. we see women's ambition being limited by the men around them because, yes, you are going to get money from a financial institution, you are cut down because your husband is not on board. Your husband has to act as criteria. No, we as Saharan, what we want to do is show us what you can sell. Okay, in the past 2 years, we've been selling, we've been trading, we're getting $1 million monthly. So we believe you, we know you can actually do $1 million. We don't need your husband, we don't need anything. In fact, we don't even need your previous bank statement. What we want to see is that you trade and you can turn around $1 million safely. And in our conversations with banks, a lot of times they say, why are we taking such a risk? What if they disappear with our money? Okay. And I'm thinking, it is very clear, it's an opportunity we've not really tapped. A retailer rotates $1 million, say weekly or monthly, has been in the same location for 4 years, 3 years. The value of equity they have by being selling the same things in the same location for 4 years is way higher than the amount of loan you are giving them. One, they're not going to, these people know maths, they know the calculations, they're not going to trade their equity for, they're not going to run away with that money, with your money, because they know the value of the equity they have in that space, in that market. That's one. Two, another level of security we've placed there is having direct access to their bank accounts, making our withdrawals directly. I'm just trying to say there is no need to, we need to remove all these limitations from women getting credits. Remove all the limitations. And then you ask a question, or maybe something I think of from your question. Do we try to encourage women more? I would say, first of all, we have to create the opportunity, equal opportunity. Women come, men come. Then we need to educate the public that, okay, these opportunities, women have direct, easy access to it. And yes, I think we should engage more women more in the open market spaces and say, yes, these opportunities exist. Your distributors will engage them, they have this opportunity for you. But for Saharan credit, we don't really have to do much of that because the distributors themselves are the ones bringing in these retailers. They are the ones onboarding these retailers. I think the extra work we'll do is just to ensure that there's clear communication of what we do.
Amazing. My next question, right? It's just like pick up something from how you just replied. Underwriting process, right? What do we look at? When we when we want to qualify a retailer for a credit offer, right? Unlike other financial institutions like banks and fintechs, we do not care about your bank statement. We don't want to see your, your house, how much properties you have. We are focused on what matters in your trade, right? We want to see your order history, your sales history. Whether you're a distributor, we're focused on, data that shows engagement. You understand? Engagement in terms of how much in total transaction, either in sales or others, is this person doing the distributor?
Yes.
You understand? And this is something that is very new. It's part of that's quite new in Southern Africa. In our conjunction with banks and many partners, most of them don't see this as the right underwriting process. It's quite new, it's innovative because it's an alternative way of underwriting for credit or loans. How effective, right? It's something we do every day. Talking to this lending partner. But how effective do you think this alternative data or this alternative way of underwriting is?
Okay, so it looks new, but it is only new for the financial institutions. It's not new for distributors. I asked myself, okay, I've worked with over 10 different distributors in several locations across Nigeria. And I'm asking myself, what criteria do they look at when giving credits? I basically listed what distributors already do. and I'm applying it to Saya, I'm saying, okay, before I give you credit, you need to be in the same location for. So you need to have been in the same location for over 3 years.
Yeah.
We need to see recurring sales within a range every month. We need the market's edge to verify you and say, okay, we know this person.
Yeah.
We are telling you that yes, you can give credit to this person. True. That's another criteria. Another criteria is the distributor also giving you a tick. That's one. Then your sales, as I mentioned earlier, your sales records. We give different weights to all of these criteria, and it helps us generate ratings for these retailers. Based on this, we have gone to the market, we've run a pilot with the distributor. We have access to 1,000 retailers, direct access to a percentage for this credit, and disbursed to at least 30 of them over 6 months. And the results are amazing. We've not had a full default. Yes, we've had, the first week we had a 2-day late payment. The second week we had a 1-day late payment out of 30 retailers. I think the third week we didn't have any. But the worst we've had was a 2-day.
But what was the cost? Why did it happen? What happened to the retailer?
The retailer says, I'm not done selling. I want to pay you when I'm done selling the product I bought. We reiterated the agreement we had, but the retailer was proving stubborn. This 1 out of 30 retailers proving really stubborn. In 2 days, because we did our calculations, but we actually knew that this retailer should have finished selling in a week. But for some reason, whether true or not, it took us 2 extra days and they should need the payment. Our officers on the field made it clear to us that if this payment I'm sorry, there was a small break there. If this payment exceeds the repayment day, for retailers that do that 2 times, they are taking off our credits, our credit program. That's one. Then retailers that default, we have a collections team and an agency that tracks that, but we've not had to use them because we've not actually had any defaults yet. So I think the key here is the credit scoring algorithm that helps us determine the right kind of retailers to give credit. It limits our risk a lot, and basically gives benefits to both retailers and distributors. If I ask the second question, I can't remember. Can you come again?
So I basically asked like how effective basically I think we've answered that already. Like how effective is this type of underwriting model, for these retailers?
Yeah.
Does it like protect the lending partners who are very worried that it's not enough, right? And also does it offer more value to the retailers who are the final consumers?
Okay, for the retailers, they need it. Yes, they are paying 2.5% transaction fee, but they are able to make on the average 10 to 15% profit margins on their products. So they are making a lot of money also. So if the cost is 2.5 to make a 15%, it's a no-brainer. So the retailers want it. The distributors are taking the whole risk and stress off their hands. It's something they really want. For the lending partners, there's a fear of what if these people decide not to pay. So yes, we have our credit algorithm that helps us minimize risk on one side. 2, we have access to all their bank accounts. That retailer cannot open a bank account in Nigeria or other countries that we don't have access to. We are able to, now we are not doing physical, for example, during our pilot, we're still collecting monies physically at the beginning stage of our pilot. But now the money is just taken from the accounts. So we're not going to have any case of a 2-day delay. And if the money is not even in the account, there are further repercussions to such credit. In fact, the account will be reading a minus. If they empty the account and they have a 0 naira, the account will be reading a minus, say $100.
This more like a collection. So the collection charge for Saharan credit is basically that we can do direct debits on the seller's account.
Direct debits.
And yeah, fantastic. Well, what for tellers that have access to cards? Is supposed to charge their cards?
Yeah, that's what I'm saying. We charge the direct debit is not on their cards. Yeah, so but now there's a third level of precaution that Saharan credit has. We've never had to use it. It's also in our agreement with retailers that if Saharan has to come and get inventory back from them, or any kind of inventory within their store that is the value of the credit you're giving them, we'll have them agree to that also. And so far, it's been an easy agreement. So that's the third level of check that we've never had to use.
Probably don't get there. Because one thing that is our vision for Saharan credit as a product is that it's able to like bring millions of people out of poverty, in Africa.
Women especially.
Yeah. And the underwriting models are quite efficient. They're to like pick out the best people you should give a credit, and the probability of them paying this credit to us and our lending partners. But at the same time, you want to make sure you're able to reach enough retailers as possible, right? And there's the issue of digitalization, in the supply chain. So, for example, we're looking at 350,000 retailers out of 1.2 million who currently who do not have records with distributors. You understand? That might sound kind of limiting. You understand? What if there be more than 1.2 million retailers in Nigeria? What if there be more than 200,000 retailers who have actual digital records or records with
Let me quickly answer that. So far, the ones that have records are about 560,000 retailers. But records are not the only criteria we have. But the ones that meet all our criteria are about 360,000. And even with that, we are not still offering credit to all of the 360,000. We are targeting 180,000 because of limitations in the credits, with the lending partners we have. And that is one of my orders. In the pilots we ran, more retailers wanted to come on board, but we're limited by the fund because we're using our funds for the pilot. We're limited by those funds. For every market you go to, everybody will give credit. All the other retailers around want to be a part of it. They're hungry to join, and during our pilot, we didn't have enough funds to like give out. So now, in 2 months' time, we should have nothing less than 300 retailers.
Yeah.
But the pressure will be a lot because more retailers want to come on board. The competition between these distributors will get fiercer because we see retailers moving towards distributors that have credits. Yeah. And other distributors will want to come on board. Even during our pilots of just a few, less than 1,000 retailers, we saw this happening. The retailers tend to move towards distributors that have credit for. We need to ensure that we have the right kind of funds to always be able to meet this. That's my fear. We're working with $2 billion now, and that's the plan. And
the needs of like specific that figure.
Right? Yes, I understand that our products can handle. We are able to scale across Africa. The tech part is easy. That is what we do. So it's easy. I see that we have a capability. But the lending part, can we, if in the next 6 months this thing blows out and we need to be giving credit for as much as 10 billion, How quickly can we get to that point? How quickly can we get? Yes, we have two lending partners. How quickly can we get more lending partners on board
to meet that need?
To meet that need? Because yes, this is a new space we are exploring. We have the numbers, but the potentials are out of this world. Are we ready? And that's the only fair. Yes, $2 billion are need to do that. But what if it goes out? Are we ready to get more lending partners? I think that's a question for you. Maybe you should tell me more about discussions around better lending and more lending partners.
Yeah, so about getting more lending partners, we've reached out to a lot of banks and other form of financial institutions who are able to lend, right? But what I've realized about getting more lending partners is not that those lending partners are not always come on board, but the cost of capital. If we give capital of 5%, which is well below the margins of the distributors, and the average distributor in Nigeria makes about 20% margin. You understand? Because they sell in wholesale, right? The retailers are doing about 10 to 15%, right? So you see the margins are, interest are quite, below that. And if you have a lending partner that is trying to give you, interest for about 10% per month, right? You actually can't, put a markup on that or offer any form of value to these retailers or distributors, right? It means you have to, either look for, where you can get cheaper cost of capital or cheaper capital, or you just, manage the little funds you have, right? And make sure you can go around and around.
So I said the possible limitation is cost of capital from new lending partners to come on board.
Yeah, not necessarily new lending partners, right? But lending partners who will not be able to give us this capital at a cheap enough rate. Yeah, right. So the cost is well above what we currently do for this kind of distributors. Then it doesn't scale. It doesn't help us scale.
And we need to make sure that all the stakeholders get the right value from this: the distributors, retailers, wholesalers, the parent company. Everybody gets enough value from this. So there's a limit to the amount to the cost of capital we can play with, which it's something that we need to really focus on and close out. Because yes, 2 is great.
Yeah.
I think the strength of yes, we have the biggest guys on board in Nigeria, the biggest banks in Nigeria on board. But I'm thinking the biggest guys in the world on board as lending partners.
To be honest, I see what the IFC, other institutions are doing around the space to be not one day to have them, but trying to scale our solution across Africa, other emerging markets, Latin America, and South Asia too. So the possibility for scale for what we do it's enormous, right? The opportunity is about a $5.2 trillion opportunity worldwide, right? So right now it's about supply. How much supply of funds do you have? So we are a lot more like supply constraints, but we can see a very huge market pool. You understand, for what we do, right? And basically the fundamentals of this type of business, being the cost of capital, the underwriting model, right, are well taken care of. But if we can scale these particular factors, to a stage where it's easy to scale this solution of other markets and serve more retailers, bring more people out of poverty, then I can say, we've succeeded. If you are doing.
Yeah, I totally agree with you, and we are getting there. And I think to transform the FMCG payment space, this will basically transform how we view credits, how we view payments in the FMCG space. And that's our target, taking over the FMCG payment space in sub-Saharan Africa. That's our core targets now. We're looking at scaling even wider to other regions of the world. I'm thinking so far, it almost looks like the only limitations we have now is the supply. The product is ready, the retailers are ready and have been on board with the current funds we have, and supply will always be the limitation, because no matter how much we get, we give this credit out. I'm thinking sub-Saharan Africa, Latin America, India, across board, we always have that supply. And that's why we need, I think, stronger partnerships in right world bodies that can help us actually meet these needs. We're looking at significant poverty alleviation across board. Very, very strong women emancipation. Yes, okay, you want to do business. You know what? Start this. Build a record for 6 months of sales. Or 7 months of sales. And yes, we'll start giving you credit. We have a plan of increased credits for these retailers. Yes, you've seen that you've sold for 3 months and you made your payments for 3 months. Yes, you have access to 15% more credit than you were giving before. We increase your credit by 50%. We watch how you make this repayment. It flows. We do background checks also, one-off checks, where people come and actually see your stock and see how well you're doing. Within the space of a year, somebody can increase the amount of credit we give them by 100%. And you see a woman that at the beginning does not have anything, stream is less than $10. At the end of the year, the stream is over 1,000 or more. Yeah, so we are looking at significant poverty alleviation and empowerment of women. This is the dream. This is everything. I sleep and wake up with these retailers and distributors every day, and I see this need. But the need for the retailers is personal, because it's for them. For most of them, it's about survival. That profits, and that's not why it doesn't go to the bank. Because the profit they make in a day is their dinner for that day and their breakfast the next morning. Have a breakfast so mega. Small profit they make, they finish, they use it to feed themselves, to maybe pay a week's worth of house rent or a day's worth of house rent. So the money hardly ever goes to the bank, but they're trading, and then when they can, they pay school fees out of it. They really will not need to go to the bank. And that's why they don't have necessary bank records, because the money keeps turning around. And these are the people we are trying to target. This is the future of where we are now. We are doing a good thing, and I hope we keep up and reach as many people as possible.
Yeah, I agree with you. So thank you very much, guys. Joseph has been able to properly articulate what Saharan Credit is about. If you have questions, you can send in your questions now, and we'll be willing to do justice to your questions.
If you have any questions, please, you can. We are open to answering your questions now. I think the comment box has been open for questions. So please, you can look at this and try and ask questions. We'll be willing to answer all the questions.
So the comments section is on now, so you could refresh. If you can refresh the stream URL, you should be able to access the chat section, so you can ask questions.
Okay, so we'll be taking more questions.
So we're taking more questions, and
okay, thank you very much for listening. I see we have some viewers still on, and we'll just be looking out for your questions or answer your questions as they come in. Thank you.
my email address it's on the Financial Inclusion Week dash page, where you could see something about the event, everything about the event. So you've found my email address there, my profile. Shoot me an email. I'm always willing to do a quick follow back with appropriate answers to your questions. So thank you very much, everyone. You can always reach out via LinkedIn, either to me or Joseph. And like I said earlier, my email address is on my profile on the Financial Inclusion Week page. So once again, my name is Abraham Burgess, and he's
Hi to Joseph.
so reach out to us on